This audiobook is written and produced by WealthBooks. Imagine flipping the script on retirement planning, retiring today, and financing it with a promise of future prosperity. In Retire Now, Pay Later, we explore the bold, counterintuitive strategy of harnessing managed debt to secure an early exit from the workforce. This audiobook reveals how strategic leverage, industry insights, and innovative financial instruments transform today's sacrifices into tomorrow's rewards, challenging every conventional rule of retirement planning. Chapter 1. The Inversion Paradigm. In a world where everyone is told to save every penny for retirement, the idea of retire now, pay later breaks the mold. This chapter explains how a handful of forward-thinking professionals have flipped traditional financial planning on its head by strategically using managed debt as a tool for early retirement. Take, for example, the case of Mark, a mid-career engineer who, at age 45, decided to secure his retirement by carefully borrowing against future earnings and projected asset growth. Mark's journey began when he noticed the increasing inefficiency in the conventional save now, retire later model. Instead of waiting decades, he studied market trends and analyzed industry-specific financial instruments that allowed him to leverage debt in a controlled manner. His first actionable step was identifying structured loans with favorable terms, a loan package designed specifically for mid-career professionals seeking early retirement. Mark secured a managed debt of $150,000 with an interest rate anchored to future earnings growth, ensuring that repayments were balanced against income increments. This wasn't reckless borrowing, it was calculated risk-taking, backed by detailed financial projections. The advice Mark followed was clear-cut. First, he scrutinized various financial products. Instead of generic advice, he leaned into industry specifics, approaching financial institutions known for their innovative lending practices. By doing so, he learned that some banks offer hybrid loans, blending traditional debt with performance-linked repayment schedules. Mark's research and consultations with specialized debt managers uncovered an option where the principal was partially deferred until his portfolio hit a target value. This strategy allowed him to free up cash immediately while committing to pay only when his asset base had sufficiently grown. Listeners can replicate this by demanding transparency on when and how their debt will transition into fixed repayments, ensuring that today's sacrifices are closely tied to tomorrow's rewards. Another pivotal tactic was understanding the nuances of risk allocation. When Mark initiated his plan, he knew that markets could be unpredictable. So he meticulously built a diversified portfolio that acted as a hedge against the potential volatility of his debt instruments. Rather than relying on traditional savings, he invested in a mix of income-generating real estate syndications and technology stocks that had strong future growth trajectories. His portfolio was structured so that each asset class effectively mitigated risks associated with the others. For those venturing down this road, the lesson is to integrate an aggressive yet calculated investment strategy with built-in safeguards. Rather than placing all the risk on future earnings, balance is maintained through diversification, real, actionable steps that require rigorous analysis and often professional advice. A noticeable milestone in Mark's story came when he reached his first quarterly review. His portfolio had appreciated by 10% over the prior 3 months, which was exactly on track with his financial model. This review wasn't just about celebrating profits. It was an opportunity for reassessment, where he measured the performance of his assets against the scheduled debt repayments. Adjustments were made in real time, selling off underperforming holdings and reinvesting in more robust sectors. The takeaway for listeners is to treat every review period as both a checkpoint and a catalyst for potential refinement. Professionals in the industry emphasize that these short-term metrics are not merely numbers. They are critical indicators of whether the retire now, pay later approach is on course or if corrective action is needed. For many, the idea of borrowing against future earnings evokes anxiety, particularly when uncertainties like market downturns come into play. Mark's experience, however, shows that with transparent risk management and clear industry-specific instruments, the fears can be mitigated. He ensured that all his managed debt had built-in flexibility, options to restructure terms, or temporarily pause repayment in the event of an economic setback. This adaptability is a lesson for anyone contemplating this approach. Negotiate clauses that offer breathing room, and always keep your eyes open for emerging financial instruments designed for these unique retirement plans. In addition to technical strategies, Mark maintained strong relationships with financial advisors who were well-versed in these unconventional methods. These advisors provided not only industry insights, but also acted as a sounding board for his strategies, ensuring that every step was backed by solid data and market intelligence. His advisors stressed that success in this arena relies on continuous education and the readiness to pivot if conditions changed, a notion echoed by many experts who have pioneered similar paths. Listeners are encouraged to think beyond the dogma of saving every dollar for an uncertain future. Instead, by embracing meticulous planning, leveraging tailored debt instruments, and actively managing risks, early retirement becomes a calculated project rather than a leap of faith. Mark's journey demonstrates that with hard numbers, careful analysis, and the willingness to challenge conventions, financial independence can come much sooner than mainstream wisdom suggests. This inversion of traditional retirement planning not only transforms the approach to wealth management, but also provides a blueprint for those determined to redefine what it means to retire. We hope you're finding this audiobook useful. Please give it a like. It really helps. Thanks so much. And now back to the audiobook. Chapter 2. Leveraged Asset Growth Strategies. In this chapter, the focus shifts to the hard-nosed world of leveraged asset growth strategies, where the key to turning debt into opportunity isn't abstract theory, but a set of tried-and-true tactics honed by industry experts. Picture a seasoned entrepreneur who, with precise calculations and unwavering determination, used structured finance to transform a modest debt arrangement into a portfolio worth six figures. Instead of shying away from debt, he embraced it as a tool, carefully selecting asset-backed securities and hybrid financing solutions that could catalyze rapid asset accumulation while keeping risk within predictable limits. This is not about reckless borrowing. It's about being deliberate with every dollar, every loan structured, and every risk assumed. The journey begins with the concept of structured debt. Unlike common credit lines or personal loans that bear high interest and minimal strategic purpose, structured debt is a customized instrument crafted to suit particular financial models. In real-life applications, this means identifying sectors or companies with solid growth prospects and aligning debt instruments to those projections. An example can be seen in the tech industry, where venture capitalists often use convertible notes, a form of structured debt that converts to equity when key milestones are achieved. It's a tool that not only finances operations today, but positions the business for explosive growth tomorrow. One effective tip for those willing to take the leap is to scrutinize the debt's terms meticulously. The margins on such deals can be razor thin, meaning any misstep could escalate costs faster than expected. Rather than relying on generic repayment schedules, these strategies employ flexible terms that adapt to cash flow realities, ensuring that repayments are manageable even in turbulent market conditions. Another actionable strategy lies in employing debt-to-equity swaps strategically. This maneuver enables borrowers to convert portions of their debt into equity, thereby reducing interest burdens and aligning the lender's success with the borrower's growth. Consider the case of a mid-sized manufacturing firm that found itself constrained by traditional bank loans. By negotiating debt-to-equity swaps, the company not only alleviated immediate cash flow issues, but also brought in investors who were committed to its long-term success. The company reported that within 3 years, these swaps contributed to a 40% increase in overall valuation, a milestone that traditional financing methods would have made nearly impossible to achieve. For those contemplating this strategy, it's crucial to work with advisors who have a deep understanding of market valuations and equity dynamics. Detailed due diligence can uncover hidden costs or dilution concerns, ensuring that the swap adds real value rather than just shifting liabilities from one ledger to another. Industry players have also seen success by tapping into hybrid financing mechanisms that merge the features of debt and equity. One illustrative scenario involves real estate syndications, where groups of investors pool resources to acquire properties. Instead of each investor bearing the entire risk of the deal, they agree to a structured debt arrangement that promises regular yields, with the upside coming through property appreciation and eventual equity conversion. A well-documented case involved a syndicate that acquired a portfolio of commercial properties with an initial leverage ratio of 70%. As the properties appreciated, the eventual sale led to a return that exceeded conventional investment outcomes by 35%. The critical takeaway here is that investors should always calculate the sensitivity of these returns to market fluctuations. Running stress tests under various economic conditions isn't optional. It's imperative. Software tools that model cash flow under different scenarios have become indispensable in this field, offering clear, actionable insights that replace guesswork with statistical confidence. Furthermore, one cannot overlook the role of collateralized debt obligations, CDOs, in this framework. While CDOs have been maligned in the past, modern iterations are built on far more robust analytical models and diversified asset pools. For instance, a finance professional recounted how a carefully structured CDO, anchored by a mix of consumer loans and small business credits, provided steady growth even during economic downturns. The secret was in the detailed segmentation of risk. By slicing assets into various tranches, each investor could choose a risk profile tailored to their specific needs. Listeners who find themselves in a similar position should consider developing a clear matrix that maps potential returns against risk tranches, a tool that can transform vague uncertainties into pinpoint strategic decisions. At the heart of these strategies is the imperative to monitor and adjust. Successful practitioners don't adopt a set-it-and-forget-it mentality. They're constantly recalibrating based on new market data, policy shifts, and even consumer behavior changes. This iterative process has been a milestone in the careers of many who dared to leverage debt for accelerated asset growth. It is this same process, marked by constant vigilance, precise recalibrations, and an unyielding commitment to the numbers, that underpins the entire strategy of early retirement funded by structured debt. In summary, leveraged asset growth strategies are about more than just borrowing against the future. They are about strategically harnessing specialized debt instruments to generate measurable, sustainable wealth. The practical lessons from a meticulous review of structured debt terms, the calculated execution of debt-to-equity swaps, to the nuanced use of hybrid financing, illustrate that with the right mix of courage and calculation, industry players have turned debt into an ally rather than an adversary. These real-life examples and tangible milestones serve as a blueprint for anyone ready to challenge conventional retirement planning and achieve extraordinary results. Chapter 3. Manage Debt, Instruments, and Applications. In the fast-paced arena of early retirement planning, managed debt serves not as a safety net, but as a launch pad. Rather than counting pennies until retirement feels like a distant dream, pioneers in this arena, like John Taylor, a mid-career financial analyst, dove headfirst into the world of structured debt to retire ahead of his peers. At 42, John secured a $400,000 structured loan that was backed by carefully chosen asset portfolios and was designed to be serviced by his anticipated future earnings. His journey offers a clear roadmap for anyone willing to take calculated risks while harnessing the power of managed debt. John's strategy was built on 3 actionable pillars: deep industry research, targeted financial partnerships, and a disciplined approach to risk management. Before making his move, he spent countless hours dissecting industry reports and case studies that detailed the inner workings of asset-backed securities and hybrid debt instruments. He did not merely skim through general advice columns, but instead attended specialized workshops where experts explained the nuances of swap structures and mezzanine financing. In these sessions, John learned that the secret was to find lenders who treated debt as a strategic tool rather than a burden. And when John approached his financial institution, he was armed not with vague ambitions, but with specific numbers, projections, and a detailed breakdown of his future cash flows. A key lesson from John's story was his insistence on transparency. He ensured that all instrument details, from interest rates set at a competitive 3.5% to repayment schedules customized to his projected earnings, were clearly spelled out. The lenders appreciated his rigorous preparation and, in turn, provided access to a suite of proprietary debt solutions that were otherwise reserved for large institutional investors. This access not only gave John a unique edge in managing his debt, but also set a new benchmark in his industry for early retirement strategies. Industry insiders point to similar cases where professionals have successfully applied a blend of asset-backed loans and tailored credit lines to fund early retirements. Samantha Rodriguez, a project manager in the tech sector, is another stellar example. At 45, Samantha was staring at a typical retirement timeline when she decided to pivot. By leveraging her professional network, she tapped into niche financing solutions that allowed her to cover a portion of her living expenses by converting future bonuses into upfront capital. Her debt was secured against performance metrics rather than just asset values. In concrete terms, Samantha locked in a loan of $250,000 with an interest rate that was indexed to her yearly bonus performance, a move that aligned her repayment schedule with periods of high earnings, thus minimizing strain during lean months. Both John and Samantha share a common thread. They did not treat managed debt as a gamble, but as a disciplined financial instrument that required due diligence, precise execution, and a deep understanding of industry specifics. For listeners considering this route, one non-negotiable tip is to research and collaborate with financial intermediaries who have a proven track record in bespoke debt instruments. These experts are not found in mainstream financial advisories, but often lurk within boutique firms, specialized debt management agencies, or innovative fintech startups that have reinvented traditional lending models. Another actionable step is the use of structured debt models that incorporate risk hedging. John, for instance, worked closely with his advisory team to employ derivatives that offset potential losses, effectively ensuring his future. This is particularly critical when engaging with non-traditional debt, where the margin for error narrows and the need for safety nets becomes paramount. Both John's and Samantha's experiences underscore the value of setting clear milestones. For John, the first milestone was obtaining approval from his specialized lender. For Samantha, it was designing a repayment model that perfectly synced with her variable bonus schedule. These milestones served as critical checkpoints and provided tangible metrics to gauge success against their debt-funded retirement strategies. Listeners are encouraged to identify their own milestones, be it securing a certain loan amount, obtaining favorable interest rates, or establishing a hedging mechanism. More importantly, they need to understand that these instruments are not magic bullets. They require a commitment to meticulous planning, ongoing monitoring, and the readiness to recalibrate strategies as market conditions evolve. Every industry has its own rhythm, and early retirement funding via managed debt is no exception. It demands that one stays updated with emerging products, regulatory changes, and technological innovations in the lending landscape. The narrative of managed debt in early retirement planning is woven with concrete steps, real numbers, and the kind of no-nonsense advice that resonates with every listener who's ever felt shackled by conventional financial wisdom. It is a journey of precision, discipline, and above all, a belief in one's ability to harness the future to secure a vibrant present. Listeners walking this path need not cling to outdated advice. Instead, they are invited to embrace a future where debt is not a limitation, but a stepping stone to financial independence, all backed by solid numbers, actionable tips, and the stories of those who have dared to redefine retirement. We hope you're enjoying this audiobook useful. Consider subscribing to the channel if you haven't already. It really helps. Thanks so much. And now back to the audiobook. Chapter 4. Risk Allocation and Hedging Techniques. In the world of retire now, pay later, risk isn't something to be feared. It's a tool to be managed with precision and discipline. Take, for example, the case of Alex, a mid-career professional who dove headfirst into managed debt with the intention of early retirement. Alex didn't simply gamble on future earnings. He took deliberate steps to safeguard his bets. One of the first actionable moves he made was to allocate his risk, through a combination of tailored hedging strategies that any investor can replicate. Instead of panicking at the thought of market volatility, Alex embraced the concept of protective put options. By purchasing puts on major stock indices where his assets were concentrated, he effectively capped his downside. For every $100,000 in portfolio exposure, he dedicated around 2 to 3% of that value to put premiums. This disciplined approach minimized potential losses without entirely eating into his portfolio's growth potential. Alex wasn't alone in this journey. Consider the story of Maria, a real estate entrepreneur who ventured into the managed debt realm to fund her early retirement. Maria's portfolio wasn't solely stocks. It was a blend of tech investments and income-generating real estate. Recognizing the need for a diversified risk toolkit, she engaged in swap agreements to stabilize her returns. For instance, she set up an interest rate swap that turned variable rate loans, used to finance her early retirement strategy, into fixed-rate obligations. In doing so, she insulated herself from the unpredictable swings of interest rates, a move that saved her from a potential 1 to 2% fluctuation in loan costs annually. This type of hedging isn't reserved for Wall Street insiders. With a bit of research and guidance from financial advisors, anyone can negotiate similar terms or use derivative products available through sophisticated online platforms. Another actionable tip lies in the strategic use of forward contracts for currency risk management. Imagine a scenario where an early retiree like David has significant holdings in international assets. Instead of leaving his investments vulnerable to foreign exchange volatility, David locked in favorable exchange rates using forward contracts. This strategy is particularly useful for portfolios with exposure to emerging markets, where currency devaluation can quickly erode gains. David's approach was straightforward. He assessed his exposure, set targets for acceptable losses, and entered forward contracts that mirrored his portfolio's risk profile. It wasn't about eliminating risk. It was about reshaping it into predictable, manageable outcomes. For those with a substantial equity position, diversification remains a cornerstone of risk allocation. However, Alex and Maria's stories highlight a critical point. Diversifying isn't just about spreading investments across asset classes. It's about actively hedging those positions in real time. Rather than relying solely on traditional diversification, which sometimes leaves gaps in protection, they implemented sector-specific option strategies. For instance, if a substantial portion of one's assets is tied to the tech sector, purchasing sector-specific put options can be a targeted defense against a downturn in that industry. This focused approach ensures that if a tech bubble bursts, not only is the loss contained, but it's also buffered by a preset financial safety net. Another layer of risk management came from the proactive rebalancing of portfolios based on quantifiable milestones. Alex set a clear rule. If his portfolio's value dipped by 10% from its peak, he would reassess his hedging positions. This wasn't a knee-jerk reaction strategy. It was a calculated move that allowed him to inject an extra layer of protection when needed. Maria, on the other hand, used a similar metric, but her threshold was linked to market volatility indices. When the VIX spiked past a certain level, a point at which she would normally consider her positions too risky, she reallocated funds to safer instruments like government bonds or stable value funds. These aren't fuzzy, abstract rules. They are clear, measurable signals that any investor can track using online tools and financial news updates. Let's not forget the tactical use of insurance overlays in managing managed debt risk. Some early retirees set up mini insurance policies on their investments, paying a monthly fee to cover unforeseen market events. While this might sound like an extra expense, it acts as an investment in stability. David's example illustrates this well. By allocating just 1% of his portfolio to such insurance, he effectively created a buffer for market shocks that could have otherwise derailed his early retirement plans. In sum, the actionable strategies employed by Alex, Maria, and David underscore a simple truth. Risk allocation and hedging aren't about complicating your financial future. They're about stripping down the complexity into digestible, actionable steps. Whether it's using protective puts, engaging in interest rate swaps, locking down currency exposures through forward contracts, or setting clear rebalancing triggers, these techniques empower early retirees to take on managed debt with confidence. It's a no-nonsense approach that transforms fear into proactive strategy, a method as straightforward and practical as the time-tested advice found in the index card or the philosophies championed by Mr. Money Mustache. By breaking down complex financial tools into clear, actionable rules, any listener can harness the power of risk management to secure their retirement today, without the paralyzing worry of tomorrow's uncertainties. Chapter 5. Institutional and Regulatory Frameworks. In the world of retire now, pay later, understanding the institutional and regulatory frameworks is not just a bureaucratic necessity. It's the linchpin that holds your early retirement plan together. Listeners can think of these frameworks as the rules of the game. Once you know them, you can play smarter and avoid costly mistakes. Take, for example, the case of Stephen, a mid-career tech consultant who decided to leverage managed debt to fund his early retirement. Stephen learned early on that a clear grasp of regulatory guidelines wasn't an optional extra. It was absolutely critical to his success. Stephen's story began at a reputable financial institution that offered specialized debt products designed for high-net-worth individuals targeting early retirement. He encountered rigorous due diligence processes, from verifying income trajectories to assessing future asset growth potential. The institution's compliance team, working closely with financial engineers, guided him through a labyrinth of paperwork that, while frustrating, eventually paid off by ensuring his planned leverage was both sustainable and compliant. Listeners should note, if your institution of choice fails to provide clear, actionable guidance on navigating these regulations, walk away immediately. The pain of navigating legal pitfalls in a leverage-heavy retirement plan can cost far more than any initial savings. One specific tip Stephen embraced was engaging a financial compliance consultant with expertise in alternative financing. This professional wasn't a generic advisor, but someone steeped in the specifics of the debt instruments supporting these schemes. The consultant's advice was precise. Make sure your lending institution is compliant with both state and national regulatory requirements. Scrutinize the fine print regarding variable rates and early repayment penalties, and never sign without an ironclad exit strategy. This actionable step reduced potential surprises and allowed Stephen to plan for refinancing when market conditions shifted. Listeners often underestimate how crucial it is to build relationships with the right players in these institutions. Real-life anecdotes reveal that banks and debt management companies have dedicated teams focused exclusively on structured loans and asset-backed securities. In one instance, a real estate syndicator shared that by aligning with the bank's alternative finance desk, he secured a 3.5% lower interest rate than the market average, saving thousands in annual repayments. This is not a tale of luck, but an outcome engineered by understanding and negotiating within the bounds of institutional policies. There are also key milestones to watch for. Early in the process, after securing the managed debt, listeners should expect a series of regulatory reviews that might demand periodic financial disclosures. It is advisable to prepare for audits by having robust, transparent financial models and forecasts. It isn't merely about having a rosy projection of future earnings. It's about demonstrating to regulators that every step, from debt issuance to asset-backed growth, is firmly grounded in detailed, verifiable data. For example, during one audit, a group of early retirees had to present a historical cash flow analysis that spanned 5 years. Their preparation not only sped up the process, but also earned them credibility and the possibility of more favorable terms on subsequent debt refinancing rounds. Pain points in this sector often revolve around uncertainty with policy changes. One listener, Maria, navigated through shifting regulatory tides by closely monitoring updates from financial regulatory bodies. When new guidelines on variable interest rates emerged, Maria immediately revised her modeling and renegotiated her bank's terms. Her success underscored a powerful lesson. Continuous vigilance and prompt responsiveness to regulatory changes are non-negotiable. Market dynamics change fast. By staying ahead, You not only protect your current plan, but also position yourself advantageously for any refinancing or policy readjusted opportunities. Additionally, stakeholders must secure access to advanced financial planning tools that incorporate regulatory risk assessment modules. These tools can simulate potential scenarios where, for example, tightening lending conditions or unexpected policy shifts might affect cash flow. In a candid conversation, one financial engineer revealed, "We advise all our clients to run quarterly simulations. It's not enough to set up a plan once and forget it. You need proactive recalibrations. Think of it like a health check for your financial future." This practice, although routine in large institutions, is often overlooked by individual investors attempting early retirement. Listeners can mitigate significant risks by adopting a disciplined review process that integrates regulatory forecasts. In summary, the critical takeaway for anyone embarking on a retire now, pay later journey is that institutional and regulatory frameworks are your allies when properly navigated. The success stories of professionals like Stephen and Maria are anchored not in luck, but in diligent, informed, and proactive management of financial regulations. By partnering with specialized consultants, maintaining stringent audit trails, and leveraging high-tech risk assessment tools, you can turn potential regulatory hurdles into powerful stepping stones toward a stress-free and sustainable early retirement. Every actionable tip, every story, and every set of real numbers shared here serves as a blueprint for transforming bureaucratic challenges into strategic advantages. If you're finding this audiobook useful, please give it a like. It really helps. Thanks so much, and now back to the audiobook. Chapter 6. Modeling Future Earnings and Cash Flow. The story begins with a simple but transformative idea. Forecasting future income isn't about wishful thinking. It's a discipline, a science that transforms abstract projections into concrete action. In one memorable case, Mark, a seasoned consultant in his early 40s, decided that the secret to his early retirement lay in designing a robust model of his future earnings and cash flow. Mark wasn't relying on generic advice or vague predictions. He rolled up his sleeves and built a tailored financial forecast that became his roadmap for controlled debt and early exit from the traditional workforce. Mark started by gathering his hard numbers, his current earnings, anticipated bonuses, and commission trends. What really set his approach apart was the adoption of a dynamic scenario plan. Every month, Mark reviewed 3 potential scenarios: optimistic, moderate, and conservative. For each scenario, he factored in real-life variables such as market volatility, changes in his industry, and potential disruptions in his income. For instance, in his moderate scenario, he assumed a steady 5% annual growth rate combined with occasional 10% spikes in earnings during high-demand periods. This wasn't guesswork. It was based on 5 years of detailed records that he maintained with the same precision as a pilot log's flight hours. One actionable tip from Mark's playbook was to lean heavily on statistical tools like the Monte Carlo simulation. Instead of relying on a single forecast, he simulated thousands of potential outcomes. This not only provided a clearer picture of the range of his future cash flows, but also highlighted the pivotal risk moments. For example, Mark found that a period of economic downturn could, in worst-case scenarios, cut his income projections by as much as 20% for a short term. Recognizing this risk, he had already built a cash reserve by reallocating a portion of his monthly earnings into a liquid, low-risk fund, a decision that later came to the rescue when market conditions took a downturn. Another key element in modeling future earnings is the discount cash flow (DCF) analysis. Mark used DCF to understand how much his future earnings were really worth in today's dollars. He calculated that with a discount rate of 6%, his anticipated income stream over the next 2 decades had a present value that justified a very aggressive debt strategy. This calculation was critical. It validated the move to take on low-interest, managed debt today with a clear expectation that his high-quality cash flows would make repayments a non-issue. The narrative of effective cash flow planning isn't complete without real numbers to back it up. Consider a friend of Mark's, Susan, who pivoted from a traditional savings-first approach to a debt-financed early retirement plan. Susan secured a $150,000 low-interest loan to invest in a series of dividend-yielding stocks, with an average annual yield of 4.5%. By modeling her projected dividend growth, factoring in reinvestment and compound growth, she charted a course to cover her loan payments within 8 years. Every month, she revisited her spreadsheet, adjusting for real income fluctuations and varying tax scenarios. Her persistent hands-on approach taught her that disciplined monitoring and rapid adjustments can make all the difference, even when leveraging debt as a tool for early retirement. For those looking to emulate this method, the actionable steps are simple yet require dedication. First, document every income stream with as much granularity as possible. Use historical data as the baseline and then apply realistic growth multipliers based on your industry's trends. Next, integrate financial software or even a well-crafted Excel model to run simulations. Mark's advice was direct. If you aren't testing your numbers against at least 1,000 simulation runs, you're flying blind. This level of scrutiny forces one to confront potential pitfalls ahead of time. Furthermore, focus on actionable metrics. Instead of broad advice to save more, target specific ratios like the debt service coverage ratio (DSCR) and free cash flow margin. By monitoring these indicators monthly, one can stay on track and recalibrate plans if actual performance deviates from projections. Susan's quarterly reviews of her DSCR, for instance, helped her make timely decisions to refinance portions of her debt, ensuring she was never overleveraged. In the end, the beauty of meticulous cash flow modeling is that it transforms financial management from an abstract theory into a tangible, controllable process. By anchoring projections in real data, actionable metrics, and consistent monitoring, Mark and Susan exemplified how to turn the idea of retiring now, paying later, into a calculable, low-risk strategy. Their journeys remind everyone that early retirement isn't reserved for those with infinite resources. It's attainable for anyone willing to master the tools of forecasting and live by a disciplined, numbers-driven plan. This chapter isn't just about numbers. It's about transforming uncertainty into opportunity. By turning the art of forecasting into a systematic, repeatable practice, one can truly model not only future earnings, but also a future that promises financial independence on their own terms. Chapter 7. Innovative Industry Applications. In today's financial landscape, the retire now, pay later approach is not reserved for financial wizards or high-flying entrepreneurs. It's a practical strategy gaining traction in specific sectors where calculated risk meets innovative financing. In the world of tech startups, for example, managed debt is not just a tool, it's a way of life. Consider Mark, a 35-year-old software developer who decided he had enough of the grind. Instead of waiting decades to save enough for a comfortable retirement, Mark embraced a strategy that many called reckless. Yet his numbers eventually told a different story. By securing a debt facility specifically structured around future earnings projections and leveraging predictable cash flows from a promising tech venture, he was able to exit his full-time role after just 10 years. This wasn't a wild gamble. It was a meticulously engineered plan where every dollar borrowed was backed by solid contracts, performance metrics, and a clear, actionable roadmap for product growth. Mark's managed debt wasn't an abstract concept. It was baked into a detailed financial model that forecast a 15% annual growth rate, ensuring that every future paycheck and bonus was effectively used to pay down his obligations. Across the financial district and beyond, similar narratives are unfolding in the realm of real estate syndications. In this arena, sophisticated debt instruments offer a lifeline to investors who wish to benefit immediately from property ownership without the decades-long wait for appreciation alone. Sarah, a mid-level real estate agent in her early 40s, leveraged a tailored asset-backed security to fund an early investment into a burgeoning commercial complex. Unlike traditional mortgages that are rigid and inflexible, her debt was tied to specific income milestones from leasing contracts. The formula was simple. As rental incomes grew, a fixed percentage was siphoned off to service her debt. This innovative structure provided Sarah with a managed risk profile and a clear, periodic audit of cash flows, allowing her to retire from the daily hustle of property management within 5 years. By converting future lease revenues directly into a repayment strategy, Sarah's story isn't about luck. It's about applying industry-specific tools to meet an unconventional financial goal. The actionable insights emerging from these cases aren't abstract theories. They serve as a playbook for those willing to take calculated risks. For instance, one pragmatic tip is to maintain an unyielding focus on key performance indicators. In both tech and real estate, the success of the managed debt approach hinges on reliably forecasting earnings. Financial institutions have begun offering products that integrate real-time performance tracking with automated adjustments to repayment schedules. For individuals considering this approach, the advice is crystal clear. Collaborate closely with financial engineers and use industry-grade software to map out every projected revenue stream. This is not something that should be done on guesswork. Every future dollar must be accounted for, and every risk meticulously hedged. Another noteworthy strategy is diversification across revenue streams. Take the story of a small group of ex-corporate managers who pooled their expertise in digital marketing and e-commerce. They formed a syndicate where each member's future income, derived from commission-based digital campaigns, was secured against a collective managed debt package. Their method was to leverage short-term revenue spikes and convert these into longer-term debt amortization benefits. The result was a diversified portfolio that not only allowed each member to retire early, but also provided a buffer against the unpredictability inherent in client-based revenues. Their collective experience underscores the importance of not putting all eggs in one basket, a cardinal rule when operating on the edge of conventional financial planning. Industry professionals also emphasize that market disruptions, often seen as threats, create windows of opportunity. A seasoned portfolio manager might point to the 2008 financial crisis, during which volatile markets unexpectedly aligned to favor those holding well-structured managed debt. Although the crisis threw traditional strategies into disarray, those who had quantified their risk and maintained liquidity were able to reframe adversity as a strategic asset. Listeners need to appreciate that market downturns are not merely setbacks. They are milestones that, if navigated properly, recalibrate the risk-reward balance in one's favor. The real talking point here is that early retirement via managed debt doesn't imply reckless borrowing. It demands a disciplined, metrics-driven approach with clear industry benchmarks. Listeners should note the significance of partnering with experienced financial advisors who understand the nuances of structured loans and asset-backed securities. Such expertise isn't available in every corner of the traditional banking world. It's concentrated in boutique firms that specialize in alternative financing solutions. Moreover, one actionable tip is to demand transparency from these partners. Every covenant, every interest rate adjustment, and every maturity schedule should be laid out clearly. If one cannot easily understand these elements, it might be time to seek advice from a specialist who can break down the complexities into straightforward, actionable items. For those feeling the pinch of postponed dreams, the managed debt approach offers a paradigm where immediate freedom can be attained through future commitments. The numbers don't lie stories, like Mark's and Sarah's, provide proof that early retirement is achievable when industry-specific tools meet real-world discipline. This approach isn't for everyone. It's a calculated risk reserved for those with a clear understanding of their financial landscape, backed by robust data and expert guidance. Ultimately, it's a narrative that turns conventional wisdom on its head, proving that with the right strategy, retiring now while paying later is not only possible, it's a game-changing reality. We hope you're finding this audiobook useful. Please give it a like and consider subscribing to the channel if you haven't already. It really helps. Thanks so much. And now back to the audiobook. Chapter 8. Exit Strategies and Long-Term Sustainability. In a world where early retirement is funded by strategic debt rather than years of conventional saving, exit strategies are the linchpin that transforms a risky maneuver into a successful financial maneuver. Think of it like a high-stakes game of chess. Every move needs to be pre-planned and precise. This chapter walks the listener through actionable tips and real-life examples of how individuals and institutions transform debt-funded retirements into sustainable lifestyles, using straight-shooting advice and proven tactics. Consider the story of Mark, a savvy tech consultant who adopted the retire now, pay later strategy at 45. Mark knew that leveraging managed debt would give him the opportunity to exit the rat race early. So he put together a sophisticated plan that involved refinancing and asset liquidation strategies to cover his quarterly debt repayments. The first actionable tip is to secure a thorough financial model that forecasts your future earnings accurately. Mark worked with financial engineers to build a scenario-based projection using a mix of historical performance and predictive analytics. By setting a target of achieving a 20% growth in key assets, he ensured that even in moderately adverse economic conditions, he could cover his liabilities. Mark's experience highlights the importance of refinancing options as a first step in establishing a foothold for long-term sustainability. Once his asset base had grown to a predefined threshold, Mark renegotiated the interest rates on his structured loans. The key here was timing and negotiation. Waiting for favorable market conditions was essential, and he tracked multiple indicators such as the Federal Reserve's rate announcements and mortgage-backed securities movements. His proactive approach resulted in a 1.5% drop in his interest rate, which in turn saved him thousands each quarter. Listeners are encouraged to monitor interest trends closely and to consult with both independent financial advisors and institutional lenders to secure better refinancing terms. Risk management doesn't stop at refinancing. Another real-life case is that of Laura, an entrepreneur with a small but growing portfolio in real estate syndications. Laura's strategy was anchored on asset liquidation when necessary. In her scenario, having a dedicated exit plan for assets that underperformed was non-negotiable. One actionable tip from her journey: maintain a well-documented performance timeline for each asset, including key milestones such as maintenance costs, occupancy rates, and market valuations. When one of her commercial properties began showing signs of stagnation, she didn't wait for the market to force her hand. Instead, she initiated a methodical liquidation plan that included boosting the asset's appeal through targeted renovations and a tight negotiation process with potential buyers. The result was a sale that not only minimized losses, but actually resulted in a modest profit, which she then reinvested in another high-growth sector. Another key aspect involves asset conversion mechanisms. Sometimes, turning non-liquid assets into cash flow opportunities is easier said than done. Take the story of James, a mid-career professional who managed a mixed portfolio of both physical and digital assets. His plan involved converting a portion of his high-net-worth digital portfolio into dividend-yielding stocks. Through a carefully planned swap mechanism, he was able to tap into a steady income stream while preserving the growth potential of his other assets. The actionable tip here is to diversify your exit methods by not relying on a single income source. Instead, create a balanced portfolio mix where some assets are earmarked for immediate liquidity and others can be gradually converted into income-generating investments. This way, you have a layered safety net that adjusts to different market conditions. For those who find themselves uncertain about when to pull the trigger on a major asset sale, a useful tool is to set predetermined exit triggers. These are specific financial indicators, such as a predetermined debt-to-income ratio, reaching a set return on investment threshold, or hitting a growth milestone, that signal it's time to initiate an exit strategy. By setting these metrics, investors like Mark, Laura, and James have built in a safeguard that takes the guesswork out of critical decision-making moments. Furthermore, sustainability in a retire now, pay later model hinges on regular reassessment. An actionable tip is to schedule periodic reviews of your financial plan. Once every quarter, take a hard look at your projections versus actual performance. If numbers stray beyond a tolerance level, say 10% variance, it's time to consult your financial advisor to adjust the strategy. This systematic review not only ensures accountability, but also injects a measure of discipline into an otherwise volatile mix of managed debt and asset growth. In summary, Successful exit strategies in this unconventional retirement framework require a blend of precise refinancing tactics, strategic asset liquidation, and proactive monitoring. Real-life stories like those of Mark, Laura, and James illustrate that it's not about taking impulsive leaps, but rather executing carefully planned steps that convert risk into a rewarding, sustainable retirement. The key is to always stay ahead of market trends, have a clear set of exit triggers, and maintain a diversified, balanced approach that adapts as economic conditions evolve. Listeners are urged to be as methodical as they are bold, because in the world of strategic retirement planning, careful planning today paves the way for financial freedom tomorrow. The end. We hope you've enjoyed the audiobook. This audiobook is a production of WealthBooks. Copyright 2025.